I've never tried on my phone before.
Sure. Let me go ahead and share. Hold on 1 second. Let me know if y'all can see my screen.
Some people joining the call now. Oh, is there, everyone's on their phones, sorry.
Everybody's on their phone today, it seems like.
Okay. Let's see.
Can y'all see my screen?
You can, yeah.
Okay. All right. So let's say, for instance, we have price goes up. We're going to show it in the buy for instance. So it breaks. And we're going to come down here. So essentially, there was a demand right here that was able to push price higher than this last higher point. So we know that demand caused that to break out what we considered would kind of be like a supply. All right. So if price was to go up again, there has to be more demand. That pushes price up, right? So price came over and it broke whatever we had here for supply. And so what essentially we talked about when reaction point is, so say for instance there's a candle right here, and that candle, like, let me check the color real quick. Okay. So we'll pretend there's like a candle right here, right? And so essentially this whole area is a spot where we report in the demand. So as price decides to come down, price has a reaction right here. But then let's say price goes up and then price immediately goes through our demand. Well, we know that since that there was demand there, because demand previously broke a previous supply. So this demand, so watch it moving forward on the blue. Yeah. This demand took out that supply, right? Price comes down, price goes into the demand zone, it rejects, and then the demand zone rejects it a little bit, but then price goes right through our demand zone. So for that reason, we know that this is the supply, right? Supply that caused it to break that previous demand. So therefore, the reaction point that we're looking at that first interaction between the demand zone and price when it comes down. That's our reaction point. And then we see price goes further down. That's how we know that, for instance, supply is now taking over and broken demand. Does that make sense to everybody?
Definitely does. Yeah.
Yes, it does.
So there are different ways that you can look at how to draw that supply. So let me pull up trading view. I'm just going to go to any chart, and we're just going to look at an example of the demand and supply interaction. And then I'll be able to we'll look at, what does that look like. So one second, guys. I'm going to find the representation I want to use. All right. Here's the first example, right? Now, I'm going to draw this with a path. Price comes down here. Price comes up here, right? So essentially, where this gray candle is, right here, this is the demand, right? And I'm gonna actually make this orange so y'all can tell the difference. So all of this right here, we consider is demand. All right, which means that the first interaction would be right here. So it would be specifically this gray candle right here. Everybody see that?
Hmm.
That's our reaction point. So it's my first interaction with the demand zone. Now you see price gave me a bullish candle and price ended up going directly through our demand zone and created what I identified as a supply. Y'all see that?
Yep.
So that's what we mean by reaction point. That supply was the reason why I took the trade that I took on NASDAQ, specifically because I noticed that it broke through that demand zone and it went through the supply. Price came back to my supply zone and showed me the right reaction. So you can pull it a variety of different ways, but just keep in mind that your reaction point, some people pull the next candle after reaction point. Some ways other people will do it is they'll pull, for instance, the opposite color candle. So I tend to look for where's my last buy before I sold. And that's my methodology of pulling my point of interest or use my zone. And there's nothing is any other way, but pretty much the main two ways because you see more people pull of supply and demand that comes from a breakthrough reaction of a previous.
Let's see. KML says, "Can you show how you did take that trade on a lower time frame?" I believe it was the trade that was actually right in your Nasdaq.
Okay. Yeah. Give me one second.
If it's all right to do that on your phone.
Yeah. I mean, everything we do falls on the same principles, right? So here we have it came right into the supply. And so when price gets to the supply, and I could even rewind it. Okay. So price comes back. Sorry guys, I got all my alerts set up. When price is going into what my POIs. So I'm gonna go down to the 1 minute. So it's the same concept, right? So you can treat this. You see this wick, price goes and breaks through. So I'll be looking for the same thing here. There's obviously demand because it broke something higher. So this is where I'm be waiting for to look for a chart. The entries I took were on seconds, and I'm gonna give you a 1 minute example. So we're just gonna let price continue to go. And price has to break that first. Or now we can move this up because price broke through. Price barely broke through and closed to the candle body. And now I can treat this as my new low. Price break this is the demand that goes to break up. So we got price reacting right there at the demand down. Price goes and breaks through our demand. So that area right there, it could be a zone. Price tapped right back into it. This right here, where this gray candelier could be an example of this is our reaction. Right here. And it tapped into, for instance, this demand right there. I'm gonna use the lower body of this candle. And I'm gonna make this orange and call it.
Yeah, just remember, guys, whenever you see wicks, right, wicks are always responding to something on the left. So if you see rejections, most likely if you look left, you're going to see either a supply or demand zone. So whenever those wicks and those rejections get taken out by an engulfing candle beside it, that's what takes out the reaction. So those wicks are always reactions to something else to the left.
So what you have here is price bounced into the price broke through, but if you see, like Nathan said, basically for that wick, the wick tapped right back into my reaction point. You take a trade instantly and be able to go from there. And then what price did after that was price was Went on down. So, all right. Okay. So it's always the same concept, guys. And remember that price is fractal. So what that means is that what you do in a higher time frame can translate to a lower time frame as well. So you want to find the same thing. We want to see supply and demand be broken. We want to find the point that caused that break right before it ends up breaking through that level. And then after that, we want to make sure that we enter when price comes back into that level and shows us clear rejection. If you're saying limit orders, you set the limits based upon the area where it shows a strong rejection. So hopefully that makes sense to everybody.
Anybody else have any questions? Feel free to type it in the chat. Now's the
Guys, we
time.
don't bite. We just want to make sure that y'all understand every concept fully so that y'all can make sure they have consistent, profitable success.
Exactly. This is the time to ask, especially being able to see a visual on your question, a visual answer. So it's best to make the most of it if you have any. So Romeo is logged on.
Feel free to type your questions in the chat if you're just now joining, guys. Let us know if you have any questions. I want to make sure that we reserve this time to be able to answer any questions that you may have. No other questions, guys? You don't have any other kind of questions for us? Any charts that you wanted to put up or anything else that you want us to explain or trades wise, anything specific?
I just got a question there, a private one, saying how to be profitable.
That's a good question, actually. So let's put it like this, right? There are three things that are important when it comes to trading. Rob had a post about this a few weeks back. Essentially, trading has three things. You can have what you call win percentage or win rate. You can have the number of trades. And then you can have what we consider, let's say, high RR. Now, the only thing is you have to pick 2 out of 3 of these. You don't get all 3. So the way that I think we like to structure things in the pen, you can try to have, for instance, a high number of trades, and you could have a high R. Like, for instance, you could average 1 to 10 risk to reward, but it doesn't mean you win a lot of your trades. It means that you would naturally have to take more losses. Now, you can either decide, hey, I want to have high R and high win percentage, but what that means is that in day, I'm not taking that many trades. So you might see, average 1 to 10 and have the high R, but you're, for instance, maybe only taking 1 to 2 trades in a day. And then you could have a high win rate and a high number of trades, but you choose, maybe, for instance, to always exit at 1 R or 2 R. And the likelihood of your trade hitting your stop with the right strategy with an edge means that you'll have a high win percentage and a high number of trades, but you won't have high run rate. Risk to reward. So when it comes to structuring your trading plan, you have to decide which one are you willing to give up. So, for instance, for me, I don't try to take no more than 4 trades in the entire day. because I know consistently I'll manage either having a high win rate and a high risk to reward. But it's got to be in discipline that you choose and understand what are you giving up, because you can't have it all. So you have to decide, when I trade, I risk this much, I'm willing to lose this much. So in a given day, if I take my first trade and I get a win, I take my second trade and I take a loss. My third trade to break even, my rules tell me stop trading. Even though I haven't hit 4 trades in a day, it's knowing that statistically I am not trending in the right direction, and therefore I should be able to keep the money that's in my pocket now. If I have 2 losses, my first 2 trades are losses, I stop trading for the day, because I know statistically that if I start taking a whole bunch number of trades, I'm not going to have a high. It's not going to translate to a high win rate. And if you don't have that kind of discipline in structuring how you do what you do, that's not going to help you. You won't get to profitability as quickly as you want to. You have to have very strict rules, because you have to know what's really kind of at stake. So it's deciding, all right, if you want to, for instance, have high risk reward, high win rate, don't try to take too many trades a day. In fact, limit yourself. So you see, like, for instance, there are a couple other rules like I have. For instance, if I take a loss in one area, I may wait to reevaluate and see if I looked at it wrong. Sometimes, it could be price just wants to mitigate at a higher spot. Other times, I could be completely wrong. So I never take 2 trades within the same area if the first one's a loss. I may miss out on some trades, but I also prevent myself from over trading that way as well too. So there's always a trade-off in everything that you do, and that's the secret. But you have to figure out which combination of factors help you produce the results on a consistent basis. But you first want you understand what you can and cannot have, and what your trade-off, to help you to be able to structure your plan. So you just kind of, the more you backtest, the more you realize. Like, for instance, for the last couple of weeks, I've noticed that a lot of my losses came from me using wicks as a chart. And I just decided that I recently made a change to say, okay, I'm going to use nothing but body breaks. And that helped me to avoid a couple more losses, but it also helped me to improve, my risk and reward, because I caught in on better moves. So it's all these little things that you'll understand about how to execute the trading strategy, where you are on the right side of success majority of the time. And as long as you enforce rules like this to understand how you structure your day, how many trades you want to look at, what type of trades you want to look at, that's going to help you get the profitability.
Exactly. So you can imagine your trading plan. So say you have more things in your plan because you want to have that 1 or 2 or maybe 3 trades per week that are super high or. So you're going to want to have the most probable trade to take. You can have more things in your trading plan. So you're going to look for maybe a certain type of inducement. Maybe you'll only target, you'll want to enter from extreme 15-minute POIs that will take out maybe 15-minute swing structure points. And, you could be waiting, hours, if not days, to get in a higher probable trade. And that means less trades, but higher RR. So you have to figure that out, guys. Do you want more trades and a less of a percentage win rate, or are you, less trades with a higher win rate percentage, or do you want more trades and less percentage of a win rate? So that all comes down to your plan and how you want to perfect everything, and what type of person you are, what's your psychology like, what can you handle. So like Brian was saying, those 3 things, you can only have 2 out of the 3. You can't have all 3. It's absolutely impossible to have all 3, I'll tell you that. We got a question here from KML, also says, similar question, how do you take the fear out of taking trades? What do you say to that, Brian?
I think the thing that helped me, I read somewhere it said fear is the absence of knowledge. Once you know, you can dispel a lot of fears once you have knowledge that you can use to combat it. So why I say that is, like, for instance, whenever I had fear when I started trading, it was because I was very unsure of my process. I didn't have a clear process, so I didn't know what to have a clear result. I had seen so many losses back to back that I was fearful that every time I would take a loss. And part of what helped me was that I just literally went on a binge and back tested 200 times for trades. And I began to realize the more I back test, the more I paid attention to, oh, this is a mistake that I've made before in the past. Oh, you know what? Across these 20 losses here, there's something that's in common. And if you take this one thing away, then it already cut half of my losses just by that. And so when it comes to my trading, what's giving me the confidence now is knowing that I follow a plan that I've back tested myself. I've seen it myself. I've done over hundreds of trades. And if I had to say, for instance, in 100 trades, I'm confident that I could get at least half of them right. And I could get maybe another 30% on top of that, on a good day. So if I know 8 times out of 10 that I'm going to be strongly on the right side of the market following my plan, it helps me. But like I said, you won't get there until you get the knowledge that you really have. And so we emphasize backtesting, but I always say do backtesting in increments. So you take 20 trades, for instance. Look at 20 trades. What were common in your wins? How many wins, how many losses you have? Look at what was common in loss. Look at what was common in the win. Then after that, you're going to do another 20 trades based on the information that you've gained. Now you look and see, okay, did my win rate improve? Did I lose more? What was the one thing that I changed? And every time you do it in 20 trade increments, you make a small improvement. Instead of taking 200 trades consistently over a back test, you're making small incremental improvements. And what you'll notice is that towards the end of you getting past over 100, 120, 140 trades, you start to see things improve and you'll become more confident. And it'll take away the fear because you're seeing a repeated system that has a high probability of winning. Because our goal is we're never going to always win trade. We're going to lose. But we manage our risk so that we don't lose a lot. But when we win more than we lose. So it all washes out. But statistically, what are the things that you do and what are the characteristics that you see in the market that are not going to be identical? Because price never makes the exact same move. But it has the characteristics that 9 times out of 10, you can expect them to happen. For instance, every chart that you look at is completely different. It never looks the exact same, but it always follows the same structure. A chart breaks the previous supply and demand. It returns back to the reaction point. It gives us a confirmation to enter the trade, and then we take the trade. So your goal in your back test is to identify those characteristics that you can see in the market. And so that way, every time you trade, I just look to the characteristics. When I see that, I'm confident that even if I lose, I know that it may be one of those times out of 10 that I lose, but I know majority of the time it's going to perform well as long as I follow those characteristics.
Yep, exactly. Back testing is the big one. If you can, put some time into back testing, like Brian was saying, back test over 20 to 100 trades, find out what's going wrong, find out what's going right. That way you can take some fear of actually executing trades, knowing where you can, where you're going wrong and where you're going right. So the main thing is back testing. And it's something that not a lot of people really want to hear. I know when I started the SMC, backtesting to me was kind of like a task, I felt, because I was like running straight into, entries, structure, obviously. But, backtesting is one of those things where I was like, oh God, I have to backtest, make case studies. But I've, quickly learned that without backtesting and without creating a plan and proving it to myself that if I did this consistently over a period of time, I can be profitable, then, that just takes out the whole fear and everything. You'll execute those trades the same way you do when you backtest. You won't have that fear to take that trade because you've proved it before over and over again. And the best thing you can do when you backtest and case study is enjoy the process, because this whole thing is a process. It all takes time and it's quite technical. So you need to dig down and, back yourself up when you go into these trades. So back testing, that's going to take your fear out of it for sure, man, for sure.
Thanks, y'all, for the good questions.
It's fascinating as well. SMC is the one. Yeah, for sure.
Definitely.
So is that it, or does anybody have anything else just before we finish up,
One last question, guys.
Yeah.
Who wants to take the cake?
Big shout out
Anybody
to
have-
InfloJet. InfloJet passed his first phase today. Really happy to see that.
Congratulations, brother.
Smashing it. Smashing it. All right, Brian.
All right, guys. I guess we'll go
That's
ahead
it.
and call this a day. And so
Yeah.
we'll have this recording up, and it'll be up for the next 48 hours on the Teachers website. So definitely get a chance to replay. And if you have any other questions, find us on Discord. And if there's anything that you want us to, go further in depth, don't hesitate to reach out to one of the coaches. You can schedule one-on-one time as well too, so we can give you an hour of undivided time and just help you through whatever process, questions, or anything that you need, so that you can also reach profitability and crush it, just like InfoJect is doing on his challenge company. So with that, I'm going to get back to my macaroons, and I will catch y'all guys in Discord.
All right, guys. Chat to you again. See you in the group.